Hi everyone, Elvin here. So today we are going to do a short sharing topic on a very popular topic which is called So My Unit Trusts Are Down. So how? So you bought some unit trust a while ago when things were looking great. Analysts were talking about blue skies. They were saying that you can make positive returns from today's market. And then suddenly market decided to make a U-turn because of some unexpected reasons. You find yourself in a situation where your investments also made a U-turn. Veteran investors or experienced investors would probably shrug it off because they have seen it before. And in fact, they may even pump in more money. But for others, it might be a total nightmare. So what do you do, when your unit trust investments take a turn for the worst? Firstly, we must understand that statistically, not saying all, but generally, your unit trust investments should follow somewhat of the performance of the market. Does your investments focus on a specific sector or region, like Southeast Asia, or does it have a more general investment mandate? So in general, we would want to know, is your unit trust investments down because the market is temporarily lousy, or is it the fund itself is lousy? Well, statistically, most likely it is due to the market. The performance of most funds in Malaysia typically correlates with the benchmark or the market of around 75 to 90%. Anything lower than that, then the fund manager is really playing an active role in the fund. To say for certain, if your fund really follows the market, there's a bunch of signals that we can look at. It requires some study in the fund's correlation, such as the fund's R-square, the alpha, or even the beta of the fund. So if you're holding to any of the fund and would wish to find out how much does it correlate with the market, do send us a message or comment on this video and we will gladly assist you in finding out. Now, once you know that your fund is most likely down because of the market and not because of the fund manager, it's time to decide what should you do. Sell it, hold on to it, or buy even more? So the first thing to consider is to realize, why were you invested into the first place? Well, I'm hoping it is for a long-term goal or a financial goals that you're trying to achieve. Because typically or fundamentally, investing into equity funds or even some bond funds are meant to be for long-term goals. If you have studied the market, you would understand that for the past 100 years, market and economic patterns that show that normally bullish markets, meaning uptime in the market, right, or good returns in the market, usually outperform the downtime or the bearish market. Making long-term investing is compelling to investors if they can stomach the risk and even the volatility. For example, like in the 2008 global financial crisis, the Malaysian KLCI or the Malaysian market was down by 45% from December 2007 until around March 2009, only to recover by 120% at the end of 2013. During the same period, the US Dow Jones was also down by 48%, only to recover by 148% a few years later after that. The same patterns emerged during the 1997 Asian financial crisis, or even the year 2000 US .com bubble, where the market significantly fell only to rise higher when the time is given to recover. So in almost all major markets, keeping your money long enough in it does bring you some positive returns, even if in the short term you may experience some downtime, like what we are in now. You won't want to be stuck in a situation where you sold away all your investments only to realize that it doubled in value a few years later, when market recovers. So statistically and historically, by looking at data, holding on to them may be a good idea, but what about putting in more money, right? So this does a few things to your investment by pumping in more money when the market is down. Firstly, it reduces the overall cost of your investment, making it easier to break even. And secondly, you are taking in more opportunities to take advantage of the eventual upside in the market. So this strategy is called the dollar cost averaging. This is especially useful when you have entered into the market at its peak, like a lot of people. And investing more into it when it drops relieves more pressure for it to break even. However, there is still some debate if this is an effective investment strategy, with some investors that prefer to time the market properly to maximize gains. Sell when the market is up and buy when the market is down. However, this requires more investment knowledge to do, and it is surely not everyone's cup of tea. Another reason to consider if you should put in more money or not should also depend on, well, how diversified are you in your overall portfolio. If let's say that your overall investment portfolio or your overall wealth are already heavily invested into high-risk unit trusts or equity funds, then you may want to think twice in terms of putting in more money. It may not be such a good idea, especially in a risk management sense. So how much can you invest into it depends on your age, your financial predicament, your goals, your risk tolerance, and many, many other factors. Last but certainly not least, talk to your current banker, your financial consultant, or your unit trust agent for further insight. If they are not giving you a satisfactory answer on what to do going forward, then perhaps, it is time to find a new one. Again, equity funds and bond funds typically are meant for long term. Therefore, short-term movements should not make you worry too much. However, if it means that you are unable to sleep or are suffering from it, you may want to relook at your risk tolerance level versus your investments. So in summary, in general, if you could afford to hold on to the fund longer, most likely the performance of the funds would even itself out eventually. It may take a few years, it may take a few months, who knows, when things start to get better. But it is best to check your financial consultant, because investing in unit trust has some relation to your overall financial planning. So do comment or message us if you have any questions. So thank you for watching. This is Alvin from Breadbest, signing out.